Welcome to Explain the Charts. Today, September 18th, 2025, we're dissecting the S&P 500, represented by the SPY ETF, following some truly impactful news from the Federal Reserve. As we begin by looking at the daily chart spanning back to May 2024, the overarching trend for SPY has been decidedly bullish, pushing the index to new highs. This sustained upward momentum aligns perfectly with the recent Federal Reserve decision to cut interest rates by 25 basis points, marking their first reduction of the year. Reports indicate S&P 500 and Nasdaq futures hitting record highs in anticipation, suggesting strong underlying market optimism fueled by cheaper borrowing costs. Such a dovish stance from the Fed, coupled with hints of 2 more rate cuts in 2025, typically creates a very favorable environment for equity markets. We can observe a clear channel of higher highs and higher lows, reflecting this bullish sentiment, with SPY trading near the 660 level as of late yesterday. However, market reactions are rarely straightforward, and there were indeed some nuances following the Fed's announcement that we need to investigate on shorter timeframes. Now, let's zoom in on the 1-hour chart to examine more recent price action leading up to the significant Federal Reserve announcement. Looking at the period from late August to early September 2025, we can see SPY trading in a relatively tight range between approximately $635 and $650. Volume was consistent, but not exceptionally high during this consolidation phase, indicating market participants were likely awaiting a clear catalyst. The $640 level appeared to act as a significant psychological support, with multiple bounces occurring off this price point. Conversely, overhead resistance consistently capped rallies around the $649 to $650 range during this period, forming a clear ceiling. This pre-Fed data highlights a market holding its breath, positioned for a decisive move based on policy shifts. Traders were keenly watching for a breakout or breakdown from this range, which the subsequent news would provide. Keep in mind this 1-hour data concludes on September 8th, so the immediate reaction to the Fed's September 17th decision is not yet visible here. To capture the immediate market reaction to the Federal Reserve's interest rate cut and Chair Powell's press conference, we must turn to the 15-minute chart for September 17th, 2025. The market initially jumped on the news of the rate cut, as evidenced by a strong bullish candle around 1757 Universal Time Coordinated, pushing prices from 659.14 to a high of 661.72. This sharp upward movement confirms the initial euphoria and the market's positive interpretation of the Fed's dovish signal. However, this rally was short-lived. As Chair Powell began his press conference, the market reversed course, turning significantly lower. The very next 15-minute candle, from 1812 Universal Time Coordinated, saw a steep decline from 660.24 to a low of 657.13, indicating substantial profit-taking and a shift in sentiment. Subsequent candles continued this bearish pressure, reaching an intraday low of 654.3 around 1842 Universal Time Coordinated. This dramatic swing illustrates that while the rate cut itself was bullish, Powell's commentary likely tempered expectations or introduced new concerns, causing investors to de-risk. The price action suggests that around the 660.50 to 661.70 region, strong resistance was met, and the market failed to sustain the breakout. For short-term traders, this highlights the importance of real-time news interpretation and agility, as the initial pump quickly turned into a dump. The 654.3 level proved to be a critical intraday support, as price consolidated and slightly recovered above it in the later hours. Volume also spiked significantly during both the initial surge and the subsequent drop, confirming strong institutional participation. This kind of volatility around major economic announcements presents both immense opportunity and considerable risk. Understanding these immediate reactions can provide crucial insights into broader market sentiment. Watch for these high-volume reversals, as they often signal a consensus shift, even if temporary. The day ended with SPY around 661.49, recovering some of the earlier losses, but still reflecting heightened sensitivity. Returning to our one-day chart, we can now see how yesterday's significant intraday volatility fits into the broader picture. Despite the record highs in futures, SPY itself registered a slight dip, closing down 0.13% yesterday at 659.18, confirming news reports that the index was down, despite a rare rally. This indicates that while many individual stocks may have performed well, the overall market, as reflected by SPY, experienced some headwinds, potentially from large-cap tech or general profit-taking. The 660 to 662 range now stands as immediate resistance, a level that SPY struggled to definitively break and hold yesterday. A strong push above this area, sustained by high volume, would signal renewed bullish conviction. Conversely, if SPY fails to hold around the 654 to 655 level, which acted as a bounce point yesterday, we could see a test of deeper support around $640, a level previously seen as resistance. Further long-term support exists around the 620 to 625 area, which has historically been a strong area of accumulation and previous resistance that turned into support. The market's reaction suggests that while the Fed's dovish stance is a tailwind, any perceived caveats or a lack of overwhelming optimism from Powell can quickly trigger reversals. The prediction that the S&P 500 won't return anything close to 10% in 2026 also adds a layer of long-term caution, despite the immediate positive news. This makes the upcoming days critical in determining if the initial post-Fed dip was a transient reaction or the start of a more sustained pullback. Now let's summarize the key reasons to be bullish or bearish and what to watch for in the SPY. On the bullish side, the Federal Reserve's rate cut and the signal for more cuts in 2025 are significant tailwinds, typically boosting corporate earnings and economic activity. This sustained dovish monetary policy environment often encourages investors to allocate more capital to equities, especially growth sectors like technology. Record highs in S&P 500 futures prior to the dip reflect strong underlying demand and confidence in the broader market trajectory. However, reasons for caution or bearish sentiment are also evident. Chair Powell's press conference caused a notable reversal, suggesting the market may be sensitive to anything less than unequivocally bullish statements. The current high valuations, as implied by the won't return 10% in 2026 prediction, indicate that a significant amount of future growth might already be priced in. Individual stock news, such as Eli Lilly's downgrade and Nvidia's China ban, reminds us that company-specific risks can still impact overall market sentiment. Traders should monitor volume alongside price action, strong buying volume on breakouts above resistance, or high selling volume on breakdowns below support will be crucial. Also, keep an eye on major economic data releases beyond interest rates, such as inflation reports and employment figures, which can influence future Fed decisions. Upcoming earnings reports from major S&P 500 constituents will also be pivotal. Any unexpected shifts in inflation data could quickly force the Fed to reassess its dovish stance, potentially altering market direction. The housing market data, showing a drop in building permits and housing starts, presents a mixed signal for the economic recovery, warranting careful observation. Geopolitical developments can also introduce unexpected volatility, so staying informed on global events is always important. Ultimately, market sentiment can turn quickly, as demonstrated by yesterday's intraday reversal. To recap, the immediate resistance level for SPY is firmly established around the $660 to $662 range, which was tested and rejected yesterday. A sustained break above 662 on significant volume would reinforce a bullish outlook, likely targeting fresh all-time highs for the S&P 500. Conversely, immediate support sits near the $654 to $655 level, where we saw a bounce yesterday after the post-Powell dip. Should this level fail, the next key support to watch on the daily chart is around the $640 mark, a significant zone of previous consolidation and reversal. A more substantial decline could bring the 620 to 625 region into play, which has served as robust support in recent months. Our unbiased prediction is that SPY will likely continue its upward trajectory in the short to medium term, but with increased volatility as investors digest both the Fed's dovishness and any tempering remarks. This bullish scenario is highly reinforced by consistent dovish signals from the Fed, robust corporate earnings, and stable global economic conditions. However, a break below the $654 support, especially if accompanied by high selling volume, could signal a period of consolidation or a deeper correction towards $640. This more bearish outcome would be reinforced by hawkish shifts in Fed rhetoric, higher than expected inflation reports, or significant negative corporate news. Traders should remain vigilant for volume spikes, particularly on breakouts or breakdowns, as these often confirm the strength of a price movement. The upcoming Federal Open Market Committee minutes, inflation data, and Q4 2025 earnings season will be crucial events to monitor. Always remember to manage your risk and adapt your strategy to new information, staying nimble in this dynamic market. Thank you for joining Explain the Charts, and we look forward to providing more insights in our next analysis. Stay tuned and happy trading!